What up? What up? What up? How you guys doing today? So we're back again. As I told you before, we're trying a new format in which we will be giving, if you will, some market updates. You turn that down, boy. I just almost created a loop. So I appreciate you guys bearing with me as we go through this test phase, and as we tighten up, we'll make sure to bring better and better production value to you uh, that will match the information. I think we're on point with the information. So before we get started, just a couple of housekeeping items. If you want to ask a question, please preface your question with a Q and a colon, then ask your question, and we'll do our best to get to it. If not during the live or the show, if you will, we'll answer it after the fact. So we appreciate that. If you want to make a statement, be respectful. Put an S colon in front of your statement. That way we can ferret out what's going on. Secondly, I'd ask if you're watching, give me a number one. Can't do a thumbs up. Give me a number one if the volume is acceptable, if you can hear what I'm saying. So number one, if the volume is good. And then if you feel brave, just put the abbreviation of the state or country that you're watching from. I always like to know where the information is going. And so as we get started, as you can see, today's agenda, going to be talking about the unemployment report that has been held up, but will be coming out next week. Major economic indicator as it pertains to mortgage interest rates and the economy as a whole. I know a lot of folks are interested in that. Segueing into the next topic, interest rate cuts. Did we actually have some interest rate cuts? We did over the last past week. Where did they actually, or how did the 25% basis point cut affect interest rates? Did it affect mortgage rates? We'll talk about that a little bit. Credit utilization. A lot of people that I deal with, for whatever reason, have credit issues from time to time, and they always want to know how to have the highest and best credit score. So we'll talk about that. A down payment assistance, FYI, if you will, for those of you that are looking to get onto the property ladder and use a down payment assistance program. These are a couple of things that you need to be aware of so that you can buy with confidence and know before you owe. And then last but not least, I want to talk about forced appreciation. I'm seeing a huge opportunity in 2026 for renovation loans, and that's really where the value is. So we'll talk about those things. Yeah, man. Yeah, let's get into it. Let's get into it. So, delayed, although it may be, it's on the way. What am I speaking of? I'm talking about the U.S. Economic Employment Report that we didn't have for a minute because of the government. The government was shut down. And so the last time the information came out, there was $119,000 jobs created, if you will. Don't know if that's going to be the case. Not created, but lost, if you will. But they're only projecting 50,000. I don't know. With all the stuff that you guys are seeing online, small businesses being challenged big time. There's a lot of job losses, lots and lots of job losses. So the reason that this is important is because whenever unemployment and the employment market is challenged, that bodes well for mortgage rates for reasons that might not make sense to some. But basically, it's a flight or flight type situation, meaning when things look bad, people put monies in things that can guarantee a return on investment. And one of those shelters, believe it or not, is homes or mortgage-backed securities. And so there's typically a boost whenever unemployment is starting to look bad. And if you pay attention to all the signs in the economy, things are headed that way. But it's not bad for all because everybody's not struggling. There's some folks that are thriving during this time. So if you've been on the sideline waiting for an opportunity for better rates, I didn't say 2021 or early 2021 rates, but better interest rates. Uh, Now is the opportunity. Moreover, this time of the year, if you can move or move on a property, there's less competition. So we want to keep an eye on that. It's coming out on Tuesday. You'll see a lot of reports over this week. A lot of people trying to spin it, just like the interest rates, if you will. We'll segue, and I see a error that I had on the last slide, but again, we'll fix it. We'll fix it. Here's the deal, guys. Before I go any further, this is an encouragement to those of you that are always on the sidelines, waiting for the perfect opportunity. You got to take a step, man. You got to start somewhere, and then you always put your best foot forward, but then you tweak and work things as they go. You'll never get where you want to get just waiting for the perfect opportunity. I guess that's a bonus. I digress. What I'm looking at here is the definition, right, of, if you will, how the Fed funds rate affects interest rates and what interest rates do they affect. And really, from a mortgage standpoint, you're looking at short-term things, right, or adjustable rates such as HELOCs, okay, adjustable rate mortgages. Those short-term rates will be benefited or hurt depending on which way the interest rates, the short term, the Fed fund rates go. So longer term mortgage rates, fixed mortgage rates, not so much. This is an ingredient, if you will, but it's more of a meal, a gumbo, a soup of things that affect the long-term rates. So long and short, this quarter point has really been baked in the cake, but there's going to be a lot of things happening over the next 6 months as it pertains to the Federal Reserve itself and just the overall sentiment of the people and the economy and things that have to go on. So again, I'm thinking that 2026 is going to be one of those years to where, if you have been waiting for the perfect storm, right, in some markets, home values are adjusting, although not going back to 2019 and beyond. Didn't say that. But if you been waiting, we're almost firmly into the fives. Depending on what day of the week it is over the last 30 days, I've had several days where you could get into the 5% range, the high fives. So that bodes well for affordability for those, again, of you that are looking to get onto the housing ladder or move up. And so the quantitative easing narrative that you've been hearing, not so much. These are RMTs. Another spin on, the government saying, this isn't quantitative easing, but again, you have to look at how the market looks at things. Just look at the stock market, look at the bond market. Since this announcement that Powell made on the buying back, or the government starting to buy bonds, and look at the flight from the equities over to more of a steady eddy government backed securities or government debt. And that really spells the picture. So again, this is something that, if you've been looking, first time home buyer, subsequent home buyer, investors, this is an exciting time to start preparing yourself, getting your ducks in a row, so that when it's time to move, you're not trying to gather yourself, because competition is going to be very steep. And if you just pay attention to everything that's going on, there's been a lot of movement from no credit scores with some loans, although, all you need is a bank statement to really underwrite, but no credit scores with some of the underwriting guidelines coming down the pike. Things are kind of opening up because the economy is not doing as well as some might purport that it is doing. So hopefully that makes sense. Again, if you have any questions, live or on the replay, just put a Q in front of your question and we'll do our bestest to get it answered. Moving right along. This is the credit section, if you will. Call this the utilization. What is credit utilization? Think about it this way. It's how you use the available credit that you've been extended. And why I talk about this simple concept for those of you that are like, I understand utilization. Well, if you do, well, then stop paying all these people or stop putting anxiety out on these internet streets about there's some type of secret formula for good credit. And it's just utilization. It's simply how you use your revolving lines of credit. Revolving meaning if you've been given extended $1,000 of credit from a creditor, you can go up and down that continuum borrowing money, and when you pay it off, it does not close that trade line. It remains open where you could go back. And so the best credit scores, and I was debating on doing this and I decided not to because it's not a competition thing. But if you guys want, just for receipts, I can put it on here. But average middle credit score for me is 845. Whoop-de-doo. Okay. A high credit score does not make a good person, a righteous person. And a high credit score does not mean that you are wealthy in the literal sense or, as a person. What it means is that you know how to manage debt well. And I think I do know how to manage debt because I adhere to the scriptures. I'll paraphrase: the borrower is servant to the lender. So the only type of debt that we like is debt that's tied to an asset that can either appreciate, give us tax benefits, and more, and best of all, the trifecta, produce a cash flow, a return, right? But any of those three mixtures are a good thing, and that tends to be with real estate, okay? And or businesses. And so utilization, the percentage is this: 10% or less, not 30. Think about it. Why would they want to keep you at 30% utilization? So you could keep paying interest. Okay. And most of these folks on the internet, they sell you the credit card game because they make affiliate commission, which I have no problem with, but you shouldn't have to read in the description. They should tell you that up front. And then you could temper either their enthusiasm or negativity based upon that. Okay. Every one of us that are monetized on YouTube get some type of compensation, right? The credit, the DIY, do it yourself credit service that I offer comes with a meager compensation, okay? An affiliate link, because I'm always telling you how you can do it free. And this is free 99. I'll give it to you again real quick. MyAnnualCreditReport.com. Get a copy of your information that the three major repositories are holding. Vet it, okay? If it's there and you did it, it's there and you did it, okay? Not talking about that, but your addresses, your name, are these things accurate? These are things that you can clean up or dispute to make sure that they're right. Number two, your utilization. This is the fastest way to affect your credit score on a month-to-month basis. Whatever the cycle is that these creditors report to these three agencies and other credit repositories that are out here, your utilization is key. So let's say you're at 35% utilization. Every time you break the barrier, what's the barrier? Go to 29%. Call it the nines. 19%. 9%. Zero is the best, right? So if you can't get to 10% off the top, I understand. It's not a race. This is education. You have to understand the principle and then implement it. It's hard by the yard, but it's a cinch by the inch, one step at a time. So know what you owe and then devise a plan. If you don't have any lates or collections or anything of that nature, there's the snowball method, the avalanche method, whatever psychologically fits your DNA to make you consistent, then do it. But the point of the matter is the lower the utilization over a period of time, making your payments on time every time equals a high credit score. But that score only allows you to get into debt. So if the debt that you're going to get into is not a debt that is going to benefit you via equity ownership, via tax benefits, or cash flow, or three, or a combination of the three, I would strongly admonish you not to do it, because that's all a credit score is. Let's move on. Down payment assistance. Let's talk about down payment assistance. DPA. There are a ton of them. The one that you see here on the screen, this is TSHAC, right? For all my Texas folks, this is one of the most popular ones. Texas State Affordable Housing Corporation. And the deal is this: should you choose a down payment assistance grant or second lien? This is what I want to talk about. All DPAs are not created equal, but let me give you three things that you should consider if you're thinking about using a down payment assistance. And these are things that you should understand before you reach out to your lender that you know, like, and trust, because we're in the information age. Thank you for the thumbs up to whoever that was. If you don't mind, if you could put a 1, lets me know that you can hear me very well, because sometimes some people say that they can't hear me very well. So if you could hear me, please put a thumbs up. And if you'd like to put a comment, go ahead and do so, and we'll make sure we get it on the screen. But down payment assistance, I digress, back to it. Here's the deal. You have grants, okay? You have second mortgages that require repayment. And then you have silent seconds, or seconds that are deferred for a period of time that don't require repayment. And as long as you meet the requirements, it will be forgiven. All right. And so this is what you need to do. And depending on your lender, this is what your lender really should be helping you understand is this: what's the exit strategy? What's the game plan? So that if you do utilize down payment assistance, it will benefit you, not just getting in the house while you're in it, but also the exit strategy, because of the three things that I just mentioned. If it's a grant, free 99, gratis, perfect, okay? But you got to understand the requirements for those things. So what I would say to you is this: you as a consumer, you have to understand long-term, okay? What's long-term for me when it comes to a home? 12 years or more. That's long-term. If you're 3 years or less, not only do you need to really think about the down payment assistance, but should you really even be buying? Because it might not be the best thing to do. But somewhere in the middle, 5 to 7 years, okay, these are things that you need to understand as best as you can, because nobody knows the future. But based upon your current situation and why you're getting into a home, maybe you're starting your family is growing. No, well, you're starting a family. You two people coming together, right? Maybe your family's growing. You need some more space. Think about these things and not just think about, I'm getting some free money, because nothing's free. Oh, believe me, nothing's free. Please believe me. And if someone tells you that it's free, then you need to run, because nothing is free, even grants, right? Grants aren't free. There's a cost even to those. So those are the things that I want you to understand when it comes to down payment assistance. If you're in the great state of Texas, or in any of the other states that we help folks buy in, our last update, or market update, if you will, I got to figure out what we're going to call this, but we talked about the National Home Buyers Fund. So there is a program for everybody on the income continuum, and based upon, that will determine if they're grants, repayable seconds, or deferred seconds. Okay. So reach out to the lender that you know, like, and trust. If that's us, you can hit that QR code right over there, and or look in the description and schedule a consultation. One thing about the consultation, guys, if you don't have a job, don't schedule a consultation. You got to be gainfully employed for 2 years, not the same job, but you have had to have been working. And as long as you don't have gaps over 60 days in between, then you might be ready to have a consultation. If your credit is horrible and you hadn't worked, and why are you even applying? Think about that. But if that's you, I still love you as well. Look at the free information on the channel and get yourself to a position where you're ready to have that consultation, either with me or another professional. We good on that? All right, let's wrap this thing on up. Now, this is the opportunity, in my professional opinion, in 2026 to 2030, and their renovation loans. Just closed one recently for an investor. And if you're an investor out there, you know, hard money, they call it hard because it's hard. Okay. It's hard on the terms. Might be somewhat easy to get into because once you've established yourself, it's quick. But as the homie says, convenience kills. Shout out to Kai. Convenience surely kills. And those hard money loans with those points and everything that they charge, it kills your profit or your potential return. But Fannie Mae, Freddie Mac, the government GSEs have great rehab loans, right? And the one that we just closed is for an investor, but they're even better for those of you that are going to live in the home. Why do I say that this is an opportunity? Because I think a lot of you guys are starting to realize with all of the social media and some of the sentiment, DHI, DR Horton comes to mind. Somebody's trying to hit them with a class action lawsuit because a lot of these builders and the lending company that they own, the subsidiary, right? They just play with the paperwork, but they own it. They've been accused, allegedly, of not disclosing what the proper escrow account should be when buying a home. I see it all the time. But you as a consumer are complicit as well because you want something and you want to believe the number that someone tells you opposed to what it actually is, only for a lot of people to find once the county, parish, township assesses said property and is yours. We've seen horror stories of anywhere from $200 to $1,500 a month increase, all because the taxes were not calculated, or the estimate, the closing disclosure was not done properly. So there potentially has a class action lawsuit. So because of all those things, there has been a resurgence, especially for the folks that I'm dealing with. I guess I deal with a lot of savvy people, but they understand, hey, let me buy something that's a little ugly, and then I'm going to force the appreciation. You see, all of this wealth talk that everybody's been talking about really is consumerism at its best, because most of us are buying at the top of the market, getting scared and selling or losing, right? And then the real investors buy at the bottom because you didn't really have the money to buy the house. And if I'm not talking to you, I'm not talking to you, but you know who I'm speaking of in general. People didn't have the money to buy, so they didn't have the money to keep up with the property. The deferred maintenance isn't there. And so a lot of things that go on with the value falling, and then those of you that are prepared and understand and have been educated by folks like myself that really teach on how to become wealthy, okay? And that's something that you have to be on inside before it is on the outside. I digress once again, but you're looking for a deal. There's deals to be had. All of this turnkey stuff isn't as good as some would have thought it was over the last couple of years. So great opportunity for rehab loans for primary residences, single family, duplexes, triplexes, and fourplexes, for investors and owner occupied folks, right? So that's the opportunity. So if you'd like to get some more information on that, make sure again you hit the QR code, or you see the information at the bottom, https://linktr.ee/lend2USA. Schedule a consultation and let's have a conversation to see if you're a fit. So yeah, man. I think that's it. Another successful update for this week coming. My time is up, but I thank you for yours. As I always say, guys, let's be good to one another. Let grace abound. And until the next time, indeed, y'all stay blessed.